Welcome to Beanstalk, M&J's podcast where we are sharing and showcasing our areas of expertise through conversations with practice leaders on their knowledge and experience.
Welcome back to the Beanstalk podcast here at Mauldin Jenkins, where we try and take tax, accounting, any other concepts that we here can advise on and try and break them down for our audience. Today, we're going to be talking about the big, beautiful bill, a lot of 2025 legislative changes. We've obviously talked about this before, but as we near the end of 2025, we want to talk through more of the planning concepts, everything that we might want to be thinking about as we head into the end of 2025 and beyond, right? What were the significant changes and the significant items that came out of the bill? And to help me do that, we're excited to have William Roberts here, who leads our International Tax Office, and welcoming back Jeff Dorris from the state and local side. So thank you again for being here. And William, welcome to the show.
Thanks for having me.
So, the International Tax Office, can you introduce yourself a little bit for the audience and,
Sure.
and kind of give a background of what your team does?
Sure. Well, I'm William Roberts. I head the international tax practice, as you all know. My group, we basically do two things. Well, we do several things, but two of the biggest things we do is we advise partnerships, corporations, individuals on the U.S. tax aspects of going international, meaning if they want to go overseas, what are the tax consequences of, setting up an overseas operations? If they are foreign individuals and they want to come to the U.S., what are the U.S. tax consequences of doing that? So we advise them on not only just tax consequences, but, treaty analysis and anything that will help them minimize their taxes paid on a worldwide basis. And once we advise them, we can also prepare any of the tax returns from a U.S. side to help them report those operations. So basically consulting and compliance, and, that's basically what we do. Yeah.
And Jeff, you've been you were one of the early members here on the podcast. Can you remind the audience what your team does?
Yeah, so similar to what William does on the international side, we take that more state and local. So we will advise any of our businesses that have state and local tax needs. So sales tax, personal property tax, any of that stuff. As our clients go across state lines, your tax complexities really get more complex. So as they spread their wings and grow, we advise them on how to stay compliant and how to reduce their tax liabilities.
Yeah. And we're going to try something a little different with this podcast. I feel like it's going to be, hey, we each have our own little lanes. I'm more on the federal, U.S. tax side, and you've obviously international and then state and local. So we're going to try and approach this, hey, 2025 year in, what do we need to be thinking about? Obviously, there's different things, right? From your perspective, from my perspective. So, I think the takeaways are going to be, hey, what general things do you want to be, taking away from this? What did the bill change? How is it going to change how you view your business, how you view yourself, individually and internationally, right? So, we'll see how that goes. But I guess my first question is, hey, what were the biggest, results of the bill from an international, state and local side that we need to be aware of, and kind of what did they incentivize out of that bill?
Sure. Okay. I mean, from an international tax perspective, there are basically, we have to think about outbound and inbound.
Mm-hmm.
Inbound, there really wasn't as many big overhaul changes that I can think of. It was really most of an outbound context, meaning that if you have a foreign operation overseas, back in the day, you used to be able to defer the timing of when you would bring back income from those operations. But now, since Subpart F came in, they had anti-deferral regimes, so you had inclusions if you were engaging in these Subpart F type income shenanigans. Basically, if you were engaging in foreign shenanigans, you couldn't defer that kind of income. Then in 2017, with the TCJA, they introduced GILTI to us, and GILTI basically said, well, even more than Subpart F, everything that you earned with the exception of 10% due to tangible income was coming back through something called GILTI. And GILTI stood for Global Intangible Low Tax Income, which basically meant nothing. It's
more shenanigans.
Yeah, no more shenanigans. It's all coming back with the exception of 10%. So in other words, if you had everything that wasn't Subpart F income, anything you earned was coming back with the exception of 10% of your
When you say
qualified
coming
business.
back, just mean taxing.
Yeah, I mean, yeah, it's taxed in the U.S. So you was no deferment. You had to include that income on your U.S. tax return in year one, and then to the extent you actually paid that income back in year two, you didn't have to pay tax on it again because it was previously taxed earnings and profits. So with all that being said, the new tax bill and there was achieved the whole achievement of it was trying to you got taxed at a lower tax rate. You got a 50% tax deduction under Section 250, and that basically gave you a 10.5% tax rate on that income, and then you got a 40 foreign tax credit for guilty purposes, but it was only 80%, so you had a 20% haircut. In the new OB3, which I like to say, so I don't have to say OBBBA so many times and confuse myself. Under the OB3, the 40%, the 50% tax deduction under Section 250 became 40%, which effectively gives you a tax rate of 12.6% on that guilty income. And again, guilty income, and now it's called necktie, by the way, net CFC tested income. And why they did that and why that's important is because
they're acronyms.
Yeah, right. They like it. So just think of guilty. You felt bad about this. You're kind of guilty. Now necktie is kind of enough to choke you. Kind of feel like everything's coming back, so you kind of feel the pressure, right? But necktie now, and the reason they did that because net CFC tested income, because they took away the Q-buy aspect. So if you're a foreign manufacturer and you had lots of tangible assets to produce your goods overseas, and in your CFC, that is no longer there. So therefore, if you looked at the way the calculation was, and on a form 8992, the bottom half of the form doesn't even need to exist anymore. Mm-hmm. And again, this is for tax year starting in 2026. This year, you still got to go through it, but in 2026, you don't have that, and they took away some other provisions like R&D and interest expense can only be allocated against U.S. source income, not necessarily against necktie, and that 20% haircut is now a 10% haircut. Mm-hmm. So big changes like that are coming in 2026. And one of the key takeaways, I'm sure, which we'll say over and over again throughout this this podcast, is one, you got to model all these provisions, yep. And you can't do it in a vacuum. You got to model them all as they work together, and then you got to be thinking about the compliance aspect of it. There'd be new forms, so you got to basically rework your work papers. Yep. To do your compliance. So, and we can get into all the other provisions, but
one of the other common themes I think we're going to discuss, right, is what was the intent of the bill, and it was really to encourage more U.S. investment, right? I mean, that's kind right. Of you talk about necktie. It's like, well, if we restrict international investments, and increase the tax rates, right, then really what we're doing by default is increasing the investment in the U.S. And you hit on research and development,
right?
And there's obviously a much more I guess, a push to invest in U.S. research and development versus international research and development, because right. I can expense it immediately now. And if I still invest in R&D abroad, I have a 15-year amortization period. I can't cost recover it as quickly. I don't get an R&D credit for it. And so it's I think we'll see that theme more and more, right? Of, hey, this whole push was to get even at the individual level with Trump account, like the whole push is to get cash invested in the U.S. And so that's pretty much what we're seeing from the international side. Is that right?
That's right. That's right. And again, that can't be overstressed, right? Trump, whether you like him or don't like him, it's irrespective, right? His goal, he saw how the U.S. was not manufacturing anything, sending all the IP and manufacturing jobs overseas. His regime, and with part of the TCJA, and again, this OB3 really corrects some of the things they didn't foresee or the things that really didn't work well on the TCJA. So this OB3 really kind of corrects that and makes those changes that were going to, fall off a cliff, rework them and make everything permanent. So these are permanent provisions, until Congress comes and changes them under the next regime or the next, president or whatever. But yeah, so it really does help that. And, it's funny you talk about the goal of this, and I'm going to make a Star Wars reference here, but right. I was talking to some friends over this weekend actually, and they have 25-year-old kids, 23-year-old kids, and they were expressing concern about not being able to have the American dream like they had, right? Mm-hmm. And this is all funny as we're down on the beach sipping cocktails. But and then you read, Wall Street Journal articles about, we're not making everything in the U.S. And then you get that email from that uncle about the little story about how, the guy wakes up and he drinks his coffee and out of all these foreign-made machines drives a foreign-made car and then wonders why he can't, get a great American job. So I feel like the American manufacturing and research industry is kind of like Princess Leia, right? In that scene in Star Wars where she sits down with R2-D2 and the OB3 is Obi-Wan and the OB3 is helping, it's like, help me, OB3, you're my only hope. So I feel like the American manufacturing industry is really, on its last legs. And that's what this OB3 Tax Act, at least for the tax revisions, was designed to do, was to help help Princess Leia, the American industry and manufacturing industry, regain their competitive advantage.
Well, there's certainly encouragement in, like you said, manufacturing. There's a new provision for what's called qualified production property, where if you build, real property, buildings, you can just expense them right away, once you put them in service, assuming you meet certain qualifications. But that's a big number, right? I mean, usually if you're building a building, you got to recover that cost over 40 years. But now if I can expense that in year one and basically, offset, I have significant tax savings in the manufacturing world. We've got 100% bonus depreciation, or 179 expenses, kind of two kind of go hand in hand. But yeah, I mean, there was, we want to make sure that you're comfortable with obviously the cost recovery and the tax savings associated with investing in this property, whether it's real or personal. I mean, I think that like you said, it's, this is not our only hope, but they want to encourage the investment. They want you to have some, comfort that you will get the tax benefit of that investment. And I think that's where we are.
Right? Yeah, that's right.
And Jeff, I know, federal and state kind of go hand in hand as far as the OB3 goes, but, what kind of considerations on the front end do we need to take at the state level, right? I mean, with the changes, I mean, I know each state may not necessarily adopt everything. So what do we need to be cognizant of there as we kind of go into year end?
Well, I want to welcome William and our international folks to the game. You talk about a kind of a modeling nightmare where you can't model out all these different forms and taxes in a vacuum. You have to model them together. So if you look at a 50 state income tax state modeling, well, when you have concepts, throwback rules and where states have apportionment methodologies, where there are revenues sourced from different methods from one state to the next and one industry to the next, we do apportionment plannings and things like that. So if you move income from state A to state B, how does that impact your tax return? So you can't model those in a vacuum either, right? Because if you, depending on how that state is, like Georgia, when you recognize all your income in the state on the state return, do you get a credit for other state taxes paid and that sort of thing? So you have to model that out. But the biggest thing that comes from the tax bill are how those states couple or decouple from federal taxable income. So your bill is a federal tax, right? It is not a state tax bill. So we look at, well, how does each state adopt or not adopt, and how do they conform to the federal taxable income? So you always want to consider things like your bonus depreciation. Some states conform to federal taxable income without modification, and so in that case you would get all your bonus depreciation deductions. And then some states absolutely do not want you to take bonus depreciation deductions on your state income tax return. So then you have to decouple and go back to your normal depreciation methods, or some states will have their own depreciation methods, which is whatever they can dream of. So you model all those and come out and see what your state income tax plan is. But the biggest takeaway from the bill is analyzing each state and how they are going to allow or not allow those deductions.
Yeah, and I think one of the biggest takeaways from the bill at the state level was kind of the SALT deduction, right? And we heard SALT for so long, right? Of, hey, they're going to take away our SALT, our PTE regime, which is kind of allowing us to deduct SALT or state and local income tax at the entity level for qualified businesses. And a lot of states, I feel like, kind of had their state and local deduction regimes tied to the expiration of the 2017 bill, right? And so I think you've got a lot of states now that are either, hey, these PTE regimes have expired, or they're in flux, or things like that. I mean, have you heard anything, or what is there to consider there in terms of, hey, we might lose these deductions, we might not? Like, what do we do if we don't know?
And right now there's not a lot of movement. I mean, I think you mentioned it, that the way they were were structuring those was based on the TCJA, right? So states, it takes a long time for Congress to adopt, even though we weren't necessarily expecting as quick of an adoption for OBBA as it came out, but states are notoriously even slower. So once the OBBA comes out, states have started to discuss what they're going to do with that, but there's not been a lot of movement yet. So we'll see. Yeah. It's an unknown, but it is a high dollar unknown potentially if you're in the right industry and in the right state. So there's a lot of your political action campaign folks are out there lobbying for new adoptions, I guess we could call them.
So with some certainty on the federal side comes extreme uncertainty on the state side.
Always.
Right? And certainty on the federal side, I feel like, is not as certain as it used to be. But here's why I'm excited to kind of have everybody here to discuss this, right? Because, and William, you and I were talking about this beforehand, right? Is, yes, there's a push for an investment in the U.S. But sometimes what's best for U.S. tax might not be best for international tax, right? I mean, if I can write everything off 100% here, well, maybe that impacts me negatively, on the international side or the state side. And so, I think what we want to get around to when we're talking about, year-end planning is it might not be just year-end planning, right? It almost is just, hey, we need to take a fundamental look at your structure. That's right. How everything is taxed, not just at the end of this year, but going forward, right? That's right. Because I think there's, with interest rates changing, with interest deductibility rules changing, new exclusions for 1202 stock, certain things like that. I mean, let's start on the international side. Like, what kind of structural discussions do we need to be having, or what's an example of where, hey, something here might not be as good if I operate abroad, things like that.
Right. And, just real quick, let me before I answer that question, let me talk about what is creating this investment in the U.S. push. And it's something called, what used to be called FDII, Foreign Derived Intangible Income. Mm-hmm. And now it's called FDAI, which is Foreign Derived Deduction Eligible Income. So another acronym to remember. But basically what it is saying is kind of like GILTI, but this is the U.S. version. If you have a U.S. person who is providing or selling goods or providing services to an overseas market, they get a 33% deduction under Section 250 on that income earned overseas, and that's under the new OB3 provisions. But the thing that is kind of helping U.S. manufacturers is, if you're a really heavy capital intensive, manufacturing asset type of entity, like whether it be car manufacturers or, whatever, making widgets, right? And you had all this high dollar, all these high dollar assets and buildings on your books, then, or, your production assets, again, that QBI was a 10%, exclusion from your, at least in this case, FDAI income. And a lot of times that was greater than the actual income you earned. So a lot of times these manufacturers couldn't take advantage of this FDAI deduction. So by removing that QBI just the same way as it did in GILTI, it was kind of a penalty for the foreign investors, but it's kind of a gimme, benefit for the U.S. manufacturers because they don't have to worry about that now. So more income is subject to the 14% rate, and again, you don't have to do the R&D and interest expense portion against that. Well, how all that ties together is GILTI and FDAI. Well, necktie and FDAI work hand in hand. So under Section 250, you get a combined deduction that is only applicable if there's income. So in other words, if you don't have income, or if you have more of these two types of income greater than just your standard non-FDAI and non-necktie income, then you actually have to reduce both of those under the provisions so you don't overtake your U.S. income. So to the extent you create, a plant, or you buy a bunch of equipment and you create a net operating loss, then that not only affects your Section 250 deduction, but also for GILTI purposes and your foreign tax credit purposes, you can't take a foreign tax credit if you have no worldwide income, or if you have a loss for worldwide income. So to the extent you start messing around with, hey, this great, these new plants, these new pieces, parts, and machinery looks great. Let's buy a bunch of them, write them all off, and now you've created an NOL, which from a U.S. only perspective, that's awesome. From a state perspective, that's awesome. You get all this good stuff and you don't have to pay tax on it. Well, if you just created a $100 million inclusion of FDAI income, you can't take that foreign tax credit now. And the thing is you've wasted that foreign tax credit, because unlike Subpart F, where you can kind of bank those foreign tax credits, FDAI, necktie guilty,
Can't be
those, they can't be carried forward. So you've lost that ability to take that foreign tax credit. So that's the thing. You push here on bonus depreciation in the plant, you lose your ability to possibly take a 250 deduction or a foreign tax credit under necktie. Right. So you got to plan that very carefully in addition to the states.
I think what we'll take away from that, right, is you really got to model this stuff out, because what's good for me is not good for you, is maybe good for, it really does take a real just model, right?
Right,
I mean,
right.
And a lot of assumptions. And, I think one of the, to kind of tie into that, right? I think one of the exciting things that came out of the bill from on the domestic side was, we were able to expense 174 R&D costs, immediately, and also catch up on R&D costs, right? Well, and there was a provision that if you were a small enough taxpayer, you could go back and expense and amend your returns and expense and maybe claim refunds. Well, you really start digging into it, and doesn't really make a lot of sense for a lot of people, because, hey, well, if I go back and amend, well, now I have interest deductibility implications, right? I have state implications, and I have what's called 280C implications, where I might not actually get the entire benefit of that deduction in a prior year. But hey, I've got this opportunity to deduct it in the next 1 or 2 years after the enactment of the bill. And so there are circumstances where, hey, it makes sense to go back and amend, but most of the time it's, well, let's take it in the next year or two and, add on to the complexity of, well, if I take it all in year one and I'm operating abroad and I drive myself into a loss, well, man, that might hinder my ability to, really take advantage of everything. So maybe I need to amortize R&D costs over 2 years, right? Or if I'm limited in my interest expense ability to go backwards, So I think those are the fun discussions that you're having with clients of, yes, in a vacuum, one thing makes sense, but it might not make sense globally. And, you're more advantageous over 2 or 3 years. Like, you kind of have to, go back to the model. You don't model it in 1 year, you model it over 2 or 3 years and make sure it makes sense from a cash flow perspective, from an operational perspective, year over year, right?
Yeah, that's right. And like you say, when you're modeling the bonus depreciation and all that, you can pick and choose, right? I mean, I'm not the Fed tax expert here, but I think you can pick and choose, right? And so if you have assets that they're going to be next year or coming up, are going to be high tariff assets, and you need to start buying those now, then you need to ask yourself, okay, is this better to bonus depreciate these ones or these other assets that may not be tariff sensitive? Because we're not even talking about tariffs here. Yep. Quite frankly, that's outside the scope of this discussion, but that's also something you got to think about. And so again, if you're looking at that, and then you're right, and then you bring up the interest expense or, deductibility, and I'll let you cover 163J, but just one of the things that has to do with the new provision is starting in 2026, you can't include foreign inclusions under Subpart F or GILTI in your, adjusted taxable income base, right? So that's another thing you got to think about. So all the stuff, it's all tied together. So you really need to, get your young people to start making these models or brush up on your Excel skills, because these are not going to be your standard if-then statements. These are going to be huge spreadsheets trying to deal with all
By
this.
young people, you mean your Mauldin Jenkins advisors?
That's right. Yeah. Younger people than me, right?
Yeah. No, I mean, it all makes sense, right? And so, I guess shifting focus a little bit, right? We're talking about modeling a couple of years out, right? And so I think, and we'll get into the details, I think, in a later podcast about the true, we dove into the federal tax changes, I think, from the OBB3. And so we won't dive into that too much. I think it's more just, hey, these are things to be thinking about. I think that's what we want the takeaway to be. And so, Jeff, on the SALT side, we mentioned kind of decoupling and state versus federal provisions, and that what other things do we need to be thinking about kind of on the state and local side? Not necessarily as a result of the law change, but just kind of as we approach year end.
Yeah, I mean, the tax law obviously has its state implications, and I joked earlier about the modeling and with William, and there's absolutely modeling that goes into it. But every year I advise our clients that they need to monitor their nexus footprint. I mean, state taxation is always about nexus. Where do you have nexus? Where don't you have nexus? Nexus changes every year based on your activities, and depending on if you're a retailer and you're a remote retailer, you can have Nexus in a state for 1 year, not the next year. So it's a fluid concept, right? Where do you have Nexus? So always monitoring your Nexus footprint. That's going to change your models everywhere down the line. If you have Nexus and you build it in, and if not, you pull it out and that sort of thing. But you always monitor your Nexus footprint. You always look for opportunities. So as the problem with Nexus is when you create Nexus in a new state, well, that state may or may not tax certain items. They may not source revenue and the deductions the same way as another state that you're used to. And as businesses grow, what tends to happen is year 1 or year 1 through 50, they are locally domiciled to their state or their 1 or 2 states. And so they have a process, they have their local CPA or accountant and they build their process out. And then as they start growing, they come into new states and it's more about growth of the business and how do we become profitable and do that. And typically it's less about our tax and our accounting and that sort of thing. So then they get into this time of year and they don't realize the state tax implications, whether there's apportionment planning issues that should be done or do they need new schedules that source their sales of their revenue a different way for that state versus their other states and all those types of state year-end planning that we always advise our clients on.
Yeah and going back to earlier is better, right? And going back to our PTE discussion, I know there are some states where if you don't elect to be taxed under the PTE regime before the end of the year, well, then you're out of luck, right? You don't get that deduction. So, I think that, yeah, I mean, the earlier that you reach out to your advisors to kind of, hey, we expanded into states, we kind of want to make sure our methodologies are right. And obviously from a tax, compliance perspective, we're doing the right things. I think that's a very important takeaway from that, right? So,
well, this time of year too, we're all busy as we move into the new year. This time of the year may be the only, call it quiet time or downtime or quieter time that you have. Once you get into December and first of the year, you lose the ability to increase, and clean up your processes, right? So a lot of times we always put things aside or look at something and say, okay, this makes sense materially, we're correct. But maybe there are still nuances where you're doing something right or wrong and you need to clean it up. Well, we try to advise, let's take the time now to do it so that when we get into year 1, that could be credit related, it could be expense related, sales and use tax, it doesn't matter. But just cleaning up those processes.
I think a lot of people don't understand that, especially and we might dive into credits here in a minute, right? That 90% of that work can be done before the end of the year, right? Exactly. So, I mean, are there any credits where we need to be thinking about it or just, hey, what should we be doing as clients or advisors in the next couple of months to kind of, make compliance season a little easier for us and them?
Well, credits are a great example of, the activity that generates the credits are happening now or happen during the year. They're not after the year, right? So a lot of times we're getting close to the end of October, end of November. You can go ahead and quantify either the first 6 months of those credits, and you can do a lot of the legwork from a documentation standpoint to be able to claim those credits. Do it now so that come first of the year when we are in the midst of tax season and audit season and that sort of thing, a lot of the legwork on that has been done.
William, anything comparable on the international side, things that we need to be really thinking about before you're in? I mean, that need to be done before you're in, right? Or is it just kind of a rolling plan?
I think a lot of it is a rolling plan, but to address something that could be done now or thinking about now for sure is when you talk about your Nexus footprint. Well, you need to think about you need to look at your structure overseas, right? Mm-hmm. And obviously account for your guilty necktie changes. Think about if you're an exporter or a service provider for overseas, you need to be thinking about how the new FDII versus FDII regime changes are going to work. But more, one thing that's kind of overlooked to a certain degree, but if you had to experience it, you felt the pain, is there's something called downward attribution. It was under 958B4. In the olden days, if you had if you had a foreign parent, owned 100% of a U.S. sub and 100% of a foreign sub, you couldn't constructively attribute the ownership of that foreign sub to the U.S. sub. And then the TCJA repealed 958 OB4 and said, well, now you can constructively attribute from a foreign person. So now the U.S. sub was considered the 100% owner of the foreign sub, which created, 5471, reporting requirements, 5471 type thing, right? And then what would happen is let's just say there's the foreign parent, there was a 90%, the foreign parent owned 90% of the foreign sub, still 100% of the U.S. sub. But then the foreign sub was also owned 10% by an unrelated, third-party U.S. person, right? So under the repeal of the downward attribution rules, you had now the foreign sub was considered a CFC, which was 10% owned directly by the U.S. person, and the indirectly constructively owned by the U.S. sub. So you had a CFC, and what that was doing is these minority investors were saying, "Oh, I just want to invest in this foreign corporation and get a dividend every now and then." Well, now they're completely subject as U.S. shareholders to GILTI and Subpart F inclusions, which is something they didn't bargain for. And then in addition, the foreign sub now had all these 5471 reporting requirements. And that sounds horrible for the U.S. minority investor, and that is the case. But it was even more burdensome if you were this U.S. sub who had no direct interest in this foreign sub, but because of the downward attribution, you are now a U.S. shareholder and you have all these 5471 requirements, which is great if you only have one or two. But I've seen if you have 100 of them, then you've got all these filing requirements, which adds a lot of complexity for compliance and all that. So the OB3, it repealed the repeal. Mm-hmm. So now I'm not going to go into the super 951B provisions, but basically that downward attribution is no longer there. So what that does is you need to start thinking about your footprint and say, well, what are my new compliance, obligations? The U.S. sub being owned by the foreign parent no longer has a 5471 requirement, unless again there's these super provisions I won't get into. And then the U.S. investor, they don't necessarily have. That's not a CFC anymore, so they're now back to their traditional. They only get income inclusions if there's an actual dividend. So that's something when you do monitor and you think about, well, now that I have these new provisions, how does my organization structure look now? Yeah. I'm going to be relieved that I don't have this inclusion, but if I was getting a lot of Subpart F, what happens now? With their tax credits, I think you can still keep them, and when you make get a dividend under 960 nowadays, if there's a Subpart F inclusion further, then you could probably take those foreign tax credits. 902 was a kind of an indirect credit. They don't have it anymore because of the TCJA. But so you got to start planning for stuff like that, and then just think about, does it make sense to still keep these investments in these minority shareholders, right, in these foreign corporations? So that's definitely something you start to think about, and then just in general to monitor all the rest of the other changes. Do we really need this entity, in Croatia? Do we really need this entity in Germany? What kind of aspects are being thrown off by the new OB3 provisions?
It's just general structural planning,
right?
And and the same applies on the domestic side too, right?
That's right.
And 2017 tax law change kind of jump started. Hey, are we organized right? Are we structured right on the domestic side? Right. And I think we'll have those conversations again because there were changes to 1202 qualified small business stock, which allows more taxpayers to maybe take advantage. Obviously, the corporate tax rates are still very low. QBI, the qualified business income deduction for pass-throughs, were made permanent. So you're going to have those similar conversations on the domestic side that you had in 2017. And so I think it's a really good time to, not just for year end, but just the next year or two, right? To have those conversations of, hey, let's make sure we're aligned in our operational efficiencies and our and our structural efficiencies to take advantage of what we now know is permanent, maybe some additional exclusions in the qualified small business stock world, right, and also in the international world.
Yeah.
And then bringing in state and local, right? Let's make sure our sourcing methodologies are right for our operations and where we want to expand and credits that are available to us. So it's a fun conversation when you combine everything and you really get an idea and a sense of a client's, here's where we are now, here's where we want to get to. Well, this is a perfect time to come in and say, okay, well, if we restructure now based on your goals, hey, we could really streamline your tax efficiencies or your international efficiencies. And I think that for me, that's the main takeaway, right? I think we kind of frame this up as year-end planning, but it's really just go forward planning. We want to know what your goals are. Yeah, we can help you in the short term, but also we want to make sure it's not just a short term game. We want to make sure you're structured for the long term and taking advantage of, a little bit more certainty in the tax law, at least for, maybe the next 8 years, even though everything's permanent. Nothing's permanent.
All taxes are complex, and we see it a lot where sometimes you realize you should have done something 5 years ago and you learn the hard way that we didn't model this and we should have, or that sort of thing. Well, when you start having new bills, tax planning and whether it's year-end planning or go forward planning or whatever, your intent, one, is to reduce, if you have any opportunities to reduce your tax liability, but two, let's not have any uh-ohs, right? Yeah. So let's continue to model this and look at this, because there are a lot of changing. There's a lot of moving pieces, whether it's international, federal, state. So get it right to the best of our abilities.
Yeah, I mean, there are always one-off planning strategies that you can deploy, but a good tax structuring discussion probably takes a course of 3 or 4 or 5 years to really implement and perfect, right? So, if you're restructuring, it may take time to migrate to that new structure, properly. And, I'm sure you experienced that.
And plans change too. So you might have structured and modeled something for a plan that was in place 3 years ago, and your 3, 5, 10-year outlook has now changed for whatever reason. And so now you have the models in place to be able to go forward with those.
Yeah, I mean, it's rapidly changing, right? I mean, we've got, obviously, we talked about interest rates and interest deductibility and hey, maybe exclusions and gain exclusions that I can qualify for. So a great time, I think, to contact your advisors and say, hey, am I structured right? Or, let's have those conversations of, here's where I want to get to. What's the best way for me to get there? Right. And those are the fun conversations, I think. So, I've enjoyed this, right? So anything that we really want to take away from this, other than, hey, let's keep the conversation rolling. Let's make sure we model these things appropriately and get the right variables in there. Anything else to take away from today that you want the listeners to hear?
Well, I'll give you, real quick, give you another concrete example about how things interact, right? When I just talked about the downward attribution, and now you have these minority shareholders, and you mentioned individuals and partnerships and flow-throughs. Well, when you now have this subpart F guilty inclusion, now if you're a minority shareholder and your foreign corporation is a passive corporation, you may have just bought yourself into a PFIC, which is a passive foreign investment corporation. Now, that's horrible in and of itself. But if it's gone through, if it goes through a partnership, and the partnership, has different rules for the PFICs and everything like that, and if the partners relied on a CFC PFIC overlap, and now this thing is no longer a CFC, well, guess what? Now you're in a PFIC situation, and then you have to ask yourself, do I make a qualified election? Can I make a qualified election? Who makes it? So all these questions start popping up just by virtue of all these regime changes. And then one thing we didn't talk about real quick, I think is equally important, is under, structuring, right? We're talking about structuring here. Well, there's a new provision, at least in the international context, where, before 2026 starts, you have this whoever holds the stock of a foreign corporation on the last day gets the guilty and gets a subpart F. Starting in 2026, it's a pro rata share. So you can't rely on just saying, okay, well, if I sell my CFC stock, I don't get that subpart F income, if I sell it for the end of the year.
Kind of a per day.
Yeah, so now it's a pro rata thing. And so now that's going, so now you've got all these team of M&A people that are going to be, the due diligence side, what's the tax attributes of this, and how do you adjust your buy-sell prices? So M&A deals, to try to maybe take into account some of these foreign aspects and domestic aspects and stalled aspects, are going to have to consider this very important. Seemingly minor changes can have huge implications on the M&A world as well, because it will definitely affect the buy and sell. So in addition to this modeling, one last thing, at least from an international tax perspective, all these forms require huge work papers, right? I mean, I've worked with one client that had a 1,000-page spreadsheet, and it had all the various aspects of foreign tax credits, everything like that. So all your work papers are going to have to be redone to account for just the foreign tax aspect of it. Same thing with your study. You talk about that 50-page, 50-state model. That's going to be brutal to get your work papers. That's doing pro forma returns and all that. So, and then your Fed tax, work papers as well. So that will have to be, all those will have to be reworked for 2026 going forward.
Sure. Yeah.
Well, modeling 100%, but don't overlook things like on the state tax side. If you look at sales tax, rates change January 1 across the country in a lot of cases. Filing frequencies change. So depending on what industry you're in, if you're quarterly or semi-annual or annual filer, a lot of times they will update your frequencies as of January 1 or sometimes in the middle of the year, so July 1. So year end, be ready for those. So update your models, that sort of thing. I'm a stickler for processes. A lot of times fixed asset systems don't always get updated from a federal tax perspective because it's a balance sheet item. Doesn't impact the income tax as much, but from a state personal property tax reporting, you're still paying tax on those if they're on your books because you take your fixed asset roll. So ghost asset reviews and asset cleansing processes, all good stuff like that. On the expense side, there's a lot of manufacturing exemptions out there for equipment and things like that. So there's always situations where maybe you've had a vendor for 30 years and they know not to charge you tax because this is exempt. Well, that for whatever reason you're no longer using that vendor, or you had to go to another vendor and now they're charging you sales tax for an item that's exempt. Just reviewing all those processes. Doesn't matter what tax type you're talking about, but just year end as you're getting into it, trying to readdress all of those issues because it costs your business money if you don't.
Yeah. Well, year end and tax law changes in one, right? Kind of just give you a great, not excuse, but a good reason to just, hey, let's sit back and let's make sure it all makes sense and make sure we're in a place where we can, adhere to procedures and policies and all that. So I think that's the biggest takeaway for me, right? Is let's use this as a good catalyst to be right going forward, right?
Sorry.
Yep. Well, thank you both for joining us. This was a great discussion. I hope our clients got something out of it, and I know I got something out of it. So thank you, everybody, for listening. Please do visit mjcpa.com for more information. Thank you.